Shall we have a focus then on that weakening US economic data, James, that we've seen emerge, particularly in recent days? How would you sum up that picture?
Absolutely. It continues to deteriorate, Lisa. Retail sales came out last week, expected to be up 0.5% month on month. They came in dead flat. Also, consumer confidence, that's fallen. That was expected to come in at 93.3, came in at 88.7. Again, much weaker than expected. The only up point from consumers where they think equities continue to go higher. But if we look further afield as well, German quarterly GDP came in flat, 0.0%, which is pretty poor. But the flip side, there is some good news out there. Canadian GDP came up quarter on quarter, up 0.6%. That was expected to be negative. And India GDP came in up 8.2%. But we're actually getting some results now already from the Black Friday sales. And early signs are showing that prices were up 0.7%, but volumes were down.
Yeah,
volumes
I mean,
1%.
Obviously this is a time of year where retail sales in the US are expected to pick up, going into winter. It's the pattern of consumption generally, but to have no growth in month on month retail sales it's a pretty worrying alarm sign. And, ultimately the projection forecast will typically be higher in October, November, even higher in December. But if we're flatlining here, either the expectation is going to really be significant now to be on parity with where we want it to be in December, or we're just going to be falling short consistently, which I think is what's more likely. Yeah,
and for consumers all over the world, of course, it doesn't help if inflation is continuing to drive products upwards. I mean, who can afford it?
Absolutely.
Yeah, and on that, my point actually there, prices are up 7% coming out from Black Friday, 0.7, that's my area. So prices are up 7%, but volumes are down 1%. And if we look at the chart, the 2-year here, you can see, this is going all the way back to COVID, and you can see it's getting narrower and narrower and narrower. And actually we're getting towards this support that's coming at 3.4%. Problem the Fed have is the economy is slowing, which means they'll have to cut. And there's 85 basis points of cuts priced in over the next year. But if this filters through to inflation, they won't be able to cut. So, I mean, from a trading perspective, you have to wait here, and there's a chance if inflation picks up, they won't be cutting as aggressively, and actually yields can start to spike higher in the short end. So this is a case of wait and see.
Do we think we're still expecting that cut on the 10th?
There's definitely going to be a cut of 25. That's fully priced, but it's where we go after that. But we've got a busy December because then we have the Bank of England and the Japanese central bank on the 18th and 19th. Bank of England's expected to have a full 25-point cut, but now the market's expecting Bank of Japan to hike, which is why the equity markets are suddenly starting to fall this morning.
You don't think Jerome and his motley crew could pull a surprise and say, we haven't seen enough data in order to cut? Or, I mean, I guess the pricing, it seems to be fully baked in, but could he pull the rug from under everyone's feet?
I don't think they will, because they always like to lead the market. So I think it's back since the financial crisis, they've not surprised the market. So a couple of weeks ago, it was priced at 30% chance they cut. And they talked to the market, known as jawboning. They led the market that there's going to be a cut. I think the last thing they want to do is surprise the market, because then you get much more volatility in asset prices.
Right, let us now bring things much closer to home. What's happening in the UK after the much-awaited budget? Well, it finally came to pass, didn't it, last week? How's the market been reacting?
Actually, just before we get to the UK, another chart worth looking at here is the split economy in the US. Manufacturing continues to contract while we see AI leading the way here. So you can see more than half of the 1.6% of US GDP growth in the first 6 months of the year came from AI-related spending. On the flip side, another piece of just regional data we had last week, the Chicago PMI, that fell to 36.3 from 45.5. This is a big manufacturing hub. So you can see all the growths in AI spending, and the manufacturing hubs are really weakening. So you're getting this real two-tier economy in the US. And also in the US, if we move on to the next chart, you can see, well, this is the dollar index, and you can see we had this period earlier in the year, it sold off aggressively. It went sideways. It looked like it's going to break higher, but now actually at the last week, it started to go down again. And we're actually seeing property prices in the US falling aggressively. This is data from Zillow, and particularly in Florida. See, Orlando's down 4.5%, Tampa's down 5.1%, but then Palm Beach 5.9%, Key West is down 6.9%. It gets worse. Cape Coral down 10.4%. Fort Myers down 12.1%.
So, I mean, all of these things, you know, if you look at manufacturing, property prices and dollar index, they're all coming off. And so the traditional analysts who are looking at historical figures will be looking at that saying, all right, we're really, you know, up a creek without a paddle regarding the US economy. And yet the things that are perhaps more revolutionary to the economy, the AI boom that, you know, they seem to have a preeminence in, especially with chip manufacturing, etc. That seems to be still, despite the volatility, supporting the economy. And of course, you just don't have the historical comparisons with that. So the traditional signs of the economy failing and flailing are there, but the new growth sectors are, you know, still supporting things.
Yep. And one problem I'd say is it's very localized where you have these growth sectors. And of course, the manufacturing hubs, which are continuing to weaken.